Right now, you are running your life like a bankrupt corporation. You track your salary, your 401k, and maybe your stock portfolio, but you are completely blind to your biggest financial leak. It's not your Starbucks coffee or your Netflix subscription. It is the static objects sitting in your room right now. In the next 10 minutes, we are going to run a reverse financial report on your household, and you will realize why your stuff is actively draining your bank account every single second. Think about it. We are living in an era where the self-storage industry in the US and Europe has ballooned into a multi-billion-dollar empire. Think about the absurdity of that for a moment. People are literally paying a monthly subscription fee to rent an external, windowless concrete box just to store items that they do not use, do not need, and probably forgot existed. We've been conditioned to look at our homes as sanctuaries of wealth. If you bought a treadmill, an espresso machine, or an expensive leather sectional, you view them as assets. You look at them and think, that's what my hard-earned money bought. But a corporate accountant looking at your life wouldn't see assets. They would see massive compounding liabilities. They would see high-maintenance inventory that requires ongoing operational costs just to exist in your space. You are paying a premium to house objects that give you nothing in return. Let's reframe your entire relationship with your possessions, starting with a fundamental rule of accounting that you are breaking every single day. Everything you own costs money twice. When you buy something, you think the financial transaction is over the moment you swipe your Visa or MasterCard. You see the purchase price on the receipt and you think, that's it, that's what it cost. But a corporate accountant knows that the purchase price is just the entry fee. The real wealth destruction happens after you bring the item home. It's called the holding cost. In the corporate world, if inventory sits in a warehouse doing nothing, it's actively draining the company's cash flow through maintenance, insurance, and space utilization. Your home is no different. You are confusing buying an object with renting a long-term liability. Let's look at the cold, hard math of space. We call this implicit rent. If you live in a major urban area, whether that's New York, London, or San Francisco, you are paying a massive premium for every single square foot of your property. Let's say you live in a city where rent or mortgage payments average roughly $40 to $60 per square foot annually. Now look around your room. That high-end treadmill you bought during the pandemic that now serves as a glorified clothes rack, it occupies about 20 square feet of prime real estate when you calculate the clearance space around it. At $50 a square foot, you are paying $1,000 every single year in implicit rent just to give that unused metal a home. That oversized leather sectional you bought for the spare bedroom that nobody ever sits on? Another 35 square feet. That's $1,750 a year. You aren't just losing the money you spent to buy these items, you are actively paying a monthly tax to house things that are doing absolutely nothing for your net worth. But holding costs aren't just about physical space. They scale up through what economists call ecosystem costs. One purchase is almost never a singular event. It triggers a cascade of secondary spending that you never budgeted for. There's a famous historical case study on this called the Diderot effect. The 18th century French philosopher Denis Diderot lived most of his life in poverty, but then he received a massive sum of money and decided to treat himself to a gorgeous luxury scarlet robe. It was beautiful, but there was a catch. Once he put on the magnificent robe, he looked around his apartment and realized his old straw chair looked pathetic, so he bought a new leather chair. Then he noticed his old wooden desk didn't match the chair, so he bought an expensive mahogany desk. Then he needed new carpets, new artwork, and new mirrors to match the scale of his new luxury environment. Within months, Diderot was completely broke and drowning in debt. He wrote an essay titled "Regrets on Parting with My Old Robe," where he warned, "I was absolute master of my old robe. I have become the slave of my new one." Look at modern life in America or Europe today. The Diderot effect is running on autopilot. You don't just buy a road bike, you buy the specialized shoes, the aerodynamic helmet, the tracking sensors, the premium maintenance tools, and the wall-mounted rack. You don't just buy a modern espresso machine, you buy the specialized grinder, the premium organic beans, the descaling chemicals, and the artisanal cups. A single major purchase forces you to upgrade an entire ecosystem of supporting items just to keep up with the new standard you created. The purchase price was just the tip of the iceberg. The lifestyle multiplier is what wrecks your investment margin.
Minimalists and elite financial strategists understand this loop perfectly. They don't avoid buying things because they want to live in deprivation or because they hate luxury. They avoid buying things because they have run the numbers. They know that every physical item added to their inventory is a permanent drain on their capital efficiency. They refuse to let static objects dictate their monthly cash flow. But it gets worse. Your possessions aren't just stealing your cash through implicit rent and ecosystem expansion, they are targeted tracking systems for your mental energy. To stop this silent bleeding, you need to stop acting like a reckless consumer and start acting like a forensic auditor. You need a systematic framework to clean up your personal balance sheet. This is the 4-step Asset Audit Framework, designed to cut through marketing manipulation and emotional bias. Step 1 is the cost per use audit. This is your psychological weapon against retail traps like Black Friday, Cyber Monday, or Prime Day. Retailers want you to focus entirely on the discount, save 40% today. But an auditor looks at the net utility. Before you buy anything, take the projected purchase price and divide it by the realistic number of times you will use it in the next 12 months. That is your true cost. A $300 designer winter coat worn 150 times over the season costs you exactly $2 per wear. That is high utility. It's a solid asset. But that $150 smart kitchen gadget you buy on impulse because it was on sale, which you will realistically use exactly twice before throwing it into the back of your cabinet, that costs you $75 per use. It is a wildly expensive liability. The math destroys impulse spending instantly, stripping away the emotion and forcing you to confront the reality of transaction value. Step 2 is the replacement test. This is how you audit everything you already own. Walk through your home, look at your possessions, and ask yourself this specific question. If this exact item disappeared tonight, would I spend my own hard-earned money to replace it tomorrow? Be brutally honest with yourself. Would you go out and buy another fondue set? Would you repurchase that bread maker gathering dust on the kitchen counter? Would you buy those shoes you haven't worn in 18 months? For at least a third of the items in your house, the honest answer is no. You wouldn't spend a single dime to get them back. They only exist in your life right now because of sheer inertia. They're remnants of past impulses or hobbies you abandoned years ago. In economic terms, these items have a negative value. They're draining your space and your mental focus while contributing zero utility to your current lifestyle. If it fails the replacement test, it needs to be sold, donated, or thrown out. Step 3 is choice architecture optimization. This is a concept popularized by behavioral economists and financial strategists like Ramit Sethi. To fix your finances, you have to stop relying on willpower. Willpower is a finite resource that completely depletes by 5 p.m. after a long day of decision fatigue at work. Instead, you must engineer your environment to make overspending difficult and saving effortless. You need to build technological friction into your daily routine. And here's the massive twist that most people completely miss. Tech conglomerates spend billions of dollars every single year to eliminate purchase friction down to zero. They invented features like Amazon's one-click checkout and integrated Apple Pay or Google Pay so you can transfer your money to them without your brain ever processing the pain of paying. When you leave your environment completely frictionless, you're not the customer anymore. You're a product being actively farmed for your cash flow. To fight back, you have to consciously build friction. Delete the shopping apps from your phone. Remove your saved credit card numbers from your browser so you have to physically get up and grab your wallet every time you want to buy something. And force a strict 24-hour waiting period on all non-essential purchases. By the time that clock runs out, roughly 70% of your impulse desires will have completely evaporated into thin air. Step 4 is the inventory count. This sounds completely obsessive until you actually open a spreadsheet and do it. Pick just one single category this weekend. clothing, kitchen gadgets, or books. Count every single item you own in that category and write the final number down. The data will shock you. Most consumers guess their inventory low and discover they own 3 to 4 times more than they estimated. When you realize you already own 42 t-shirts, buying the 43rd shirt stops feeling like a fun reward. It feels ridiculous. The absurdity becomes completely visible. By applying these 4 steps, you reclaim control of your physical and digital environment. But this isn't just about saving a few bucks on your credit card statement. There's a much bigger macroeconomic prize waiting for you when you stop over-allocating your cash into physical junk. When you run this framework, you unlock the ultimate prize in modern macroeconomics, a metric far more valuable than any physical luxury money can buy. Author Morgan Housel calls it optionality.
Optionality is the invisible asset on your balance sheet. It is the ability to do what you want, when you want, with whom you want, for as long as you want. That is the highest dividend money pays. But you cannot buy optionality if your capital is permanently locked up in depreciating household inventory. Every dollar you spend maintaining an object you don't need is a dollar you have stolen from your future freedom. It's a direct hit to your financial opportunity cost. Let's translate your hidden holding costs into real-world leverage. Stop looking at your lifestyle inflation in terms of currency. Start looking at it in terms of time and autonomy. If you liquidate the negative value items in your home, cut the implicit rent taxes you are paying to house dead inventory, and block future impulse leaks using choice architecture, you aren't just saving a couple of $100 a month on a spreadsheet. You are building a concrete runway. Calculate your true baseline monthly survival cost. Now look at the cash flow you just reclaimed from running your reverse financial report. That money represents months of absolute freedom. It is a financial buffer. It means having 3, 6, or 12 months of living expenses sitting liquid, completely unencumbered by debt or structural overhead. Think about the psychological shift that occurs with that level of optionality. It means if your boss corporate restructures your department, you don't panic because you have a runway. If a massive macroeconomic shock hits the market, you don't panic sell your investment portfolio at the absolute bottom. You don't have to, because your household operating costs are lean and your cash margin is thick. If a high-risk, high-reward career opportunity or startup venture presents itself, you can actually take the leap because you have the structural agility to say yes. True wealth isn't about showing people how much money you have. It is about the number of choices you can make when you wake up in the morning. Now, let's address the inevitable counter-argument. Am I telling you to live in a completely sterile, empty white room with nothing but a laptop and a single spoon? Absolutely not. That is toxic minimalism. Toxic minimalism is just another form of consumer obsession. It forces you to expend massive mental energy constantly thinking about what you don't have. It is impractical, it is exhausting, and frankly, it doesn't work for real people with families and careers in the West. The goal here is not deprivation. The goal is brutal, strategic optimization. It is about cutting your expenses and your physical inventory ruthlessly on the 90% of things that bring zero real value to your life, so that you can aggressively, unapologetically invest your capital and your focused energy into the 10% that actually matters. If you love high-end coffee, fine. Spend heavily on a top-tier setup that you use every single morning to jumpstart your productivity. If you love traveling, spend on the plane ticket. But cut out the background noise. Stop paying the implicit rent on the clothes you never wear, the gadgets you never touch, and the subscription traps you forgot to cancel. When you strip away the operational drag of useless possessions, you stop running your life like a failing, over-leveraged company. You become a highly efficient financial entity, freeing up the literal and psychological space required to allocate capital into hard assets, global equities, or personal equity. You trade static, dust-gathering liabilities for dynamic, compounding assets. At the end of the day, running a reverse financial report on your household isn't about forcing yourself to live with less just for the sake of it. It's not about deprivation, and it's certainly not about feeling guilty for spending your money. It is about one thing and one thing only: reclaiming absolute control over your physical space and your economic destiny. When you stop treating your home like a dumping ground for depreciating corporate inventory, you stop leaking the vital financial energy required to build real wealth. When you stop letting algorithms, marketers, and massive retail corporations dictate your monthly cash flow, you stop being the target and you start being the auditor. You free up the exact capital, time, and mental bandwidth needed to focus on compounding assets that actually pay you back. So let's stop looking at the spreadsheets for a second and take immediate real-world action. This weekend, don't open your banking app, open your closet. Run the replacement test on just 10 items. Look at them, be brutally honest with yourself, and calculate their real holding costs. Drop a comment below and tell me, what is the most expensive thing you currently own that you wouldn't spend a single dollar to buy again today? Let's expose the hidden liabilities hiding in our own homes. If you found this strategic breakdown valuable, hit the subscribe button, share this with someone who needs to audit their lifestyle, and I will see you in the next analysis.